Hi guys. So if you've ever tried to learn the ICT concepts like fair value gaps, order blocks, optimal trade entries, and you feel confused, you're not alone. In this video, I'm going to tell you why these concepts confuse most traders and what are the other things that we can focus on. So first, this is needless to say that these concepts are not wrong per se, but when beginner traders look at these concepts, they focus on finding these things in the market than understanding how truly the market moves, which is much more important. You don't need this mumbo jumbo to understand or find your exact setups. Instead, if you just understand how truly the market moves, you will be able to find much better setups, and instead of getting confused, you're actually likely to make some money. So instead of focusing on all these concepts, what you should focus on is finding the basics of the market, which are support and resistance, trend lines, and probabilities. If you look at from a technical perspective, these are only the things that you should focus on and not anything else. And considering your mindset, the next things you need to focus on are execution, risk management, and your mindset. Now, why do I say this? I, as a beginner trader, also tried out all these concepts like fair value gaps, order blocks, liquidity sweeps, but these are numerous on the market. There is never going to happen that in the entire running day there is only one fair value gap or one order block that comes along, which creates a really big problem about which ones to actually execute. Instead, if you focus on the basic concepts and understand how the market moves, you will have a much more probability of getting to success. And the most important thing, nothing is more important than this, is your executions, how confident you are, your risk management, how you manage your risk per trade or per setup, or what kind of setups are you taking. And the next thing is mindset, which can fuck everything up, everything else up, right? So let's look at it from a chart perspective. So here I have the MNQ chart, and this is the Friday's chart. Needless to say that it can be any time frame, any asset you're looking at, and it doesn't really matter. So I was looking at the chart from here, and I typically trade the New York session. So here the chart, the market was in a range. A major range was here, this and this was the major range, right? And when I started looking at the chart, the market was somewhere near here, right? And I could see that the market was in a downward channel. So this was the channel the market was in. I'll draw it again for you guys. This was the channel, and the market was in this channel before I started looking at it. Now this candle right here was actually, one second, this candle right here was a news candle which essentially poked below the channel and also the lows of the range, and after that the price went quite bearish continuously. Now if you consider the ICT concept, there are fair value gaps in here, right? This is a fair value gap. This is also a very small fair value gap. No, it didn't form here, but yeah. So if you look at these, you don't know how will they react or not react. If I look at this, the price came into the fair value gap and then went bearish. Instead of focusing on all this, you should just look at the simple market structure. If you look at it here, the market is currently falling. Very simply, the market is in a downtrend, right? That's what you see when you look at the chart from a very basic perspective. You see the market broke below the range, the major support zone, you can say, and then the market is going back up again. Now once this happens, typically the price will form another range. That is the most likely thing that the price is going to do. If you look at the end of the day, that's what price really did. How did I form my trade here? I'm going to tell you that on a very simple basis. So I looked at this here, which was essentially a wedge. Now what is a wedge? It is no mumbo jumbo. It is simply when price comes up, goes down, comes up, goes down. So this is three attempts that price made here near these level to break these highs, but it couldn't. Every time it came up here, it became a minor resistance and price broke below. Once I saw this and I saw a strong bearish candle right here, I took the trade below this candle on the once its lows got broken. My SL was the top of this bar where the wedge was, and I was looking for a 1 to 2 risk to reward here, which got essentially executed right at the right near the end of the day. But this is a very simple setup. I don't need a lot of this. I have a good enough stop loss, I have a good enough target, and if I do this for multiple days with consistency, I will make money. Let's look at some other chart of Friday. Okay, so here you have it. Now on Friday, when I saw this, price was essentially also in a range on the gold charts. What I did see on this was price went up, price went down, it's going down, and when I saw it, price was essentially still in a bear trend here, right here, still in a bear trend. What was I looking for? Again, I was looking for some kind of structure for me to form the trades. If you look at it here, price still formed a small range right here. It started ranging, it wasn't going anywhere. I see a 3-touch wedge, a third attempt to go bearish. The wedge failed, like the price couldn't broke below it. Price went in a strong upward move right here, right? And I could see, but I wanted to take a trade right here, but I couldn't take it because the risk to reward was really off. But once the price came back here and it couldn't go below here, at this double bottom, right here on this double bottom, I took the trade right here of a long, which was essentially still a reversal trade. My SL was the lows of this low right till the last pullback, and my risk to reward was a 1 to 2. It went above my risk to reward. It went to almost a 2.5. It essentially went to 3. But when I took the trade, I exited on this bull bar, on the close of this bull bar, because I saw there was a large wick to the upside. So I exited the trade right here, which was essentially a 2.33 risk to reward. So that's it, guys. You need to focus on the basic things: risk to reward, your support and resistance, and take trades from there. If you like the kind of content I just showed you, please follow and subscribe for more tips and tricks. And I'm gonna start a new series which will be live streaming every day in the New York session from 6:30 p.m. IST to almost 11 o'clock IST. So do follow me. Okay, guys.